Welcome to the Franks Report. I'm Jessica.
And I'm Philip.
And well, if you're like most people, when you picture the financial market, you probably picture a static chart, right?
Or maybe just a screen full of flashing red and green numbers.
Exactly. But we really need to bust that myth right out of the gate, because the market is not a chart.
No, not at all.
It's actually this continuous, living, breathing auction. So today, we are taking you behind that screen to see how the machine actually works.
Yeah, we're taking a deep dive into the absolute foundational reality of market mechanics.
And we really want to stress that this show is tailored completely for you, especially if you're a beginner trying to figure out what those flashing numbers actually, represent in the real world.
Because it can be super overwhelming at first.
Oh, absolutely. So we're using this incredibly insightful excerpt from a text today, and it starts with this perfect premise. It says, a market represents the intersection of two opposing forces.
I love that quote, because people get so distracted by the colors and the flashing lights of their trading software that they forget that core mechanism.
Yeah, the actual intersection part.
Exactly.
Yeah.
At its most fundamental level, a market is just a venue for price discovery.
Okay, so break that down for the listener. What does that actually mean?
Well, whether you are looking at a centralized physical exchange in New York or a decentralized global electronic network, participants are simply negotiating the value of a security in real time.
They're just haggling.
They're just haggling.
Yeah.
I mean, every single price movement you see on your screen is the direct result of a transaction.
Wow, okay.
It is a specific historical moment where a buyer and a seller agreed on a value, they exchanged capital for an asset, and they executed a trade.
So let's strip this down to the absolute studs for you guys listening, because if we take away the computers, the algorithms, all the multi-screen trading desks...
All the noise.
Yeah, all the noise. The text we're diving into today points out that you really only need three things to make this entire system function.
Only three.
Right. First, you need an asset to trade. Second, you need a medium of exchange, which is usually a currency. And third, you need a critical mass of participants.
And that third one is where people get tripped up. Because without those three elements interacting, an asset remains completely illiquid.
Meaning you can't easily buy or sell it.
Right. And any value you assign to it is just entirely subjective. I mean, think about it. You might own the rarest painting in the world, right?
Okay.
And you might live in a country with a super strong currency.
Sure.
But if no one else is in a room willing to trade with you, you do not have a market.
You just have a painting on a wall.
Exactly. You just have a painting. So even though modern financial interactions happen in, milliseconds, the underlying principles are identical to a physical bazaar from 1,000 years ago.
That's such a great way to think about it.
You're just participating in a system designed to facilitate the transfer of ownership with as much efficiency as possible.
Okay, so if we are walking through this modern bazaar, let's look at how the actual auction works.
Let's do it.
The text breaks down the interaction between two concepts you hear all the time. The bid and the ask.
Right, the bid and the ask, the absolute foundation.
So for anyone just stepping into this world, the bid represents the absolute highest price a buyer is currently willing to pay.
Yep.
And the ask, which is sometimes called the offer, that represents the lowest price a seller is willing to accept.
And then there's the gap sitting between those two numbers.
Right, and that gap is called the spread.
And that spread, it really represents the friction of the market.
Friction, I like that.
Because it's where the reality of trading actually hits home. For a trade to actually occur, one side has to give it their ground. Somebody has to cross that spread.
Meaning they have to compromise.
Exactly.
Yeah.
A buyer has to realize, well, I'm not going to get this asset at my lower bid, so they move their price up to meet the seller's ask.
Or the seller realizes nobody is biting at their high price, so they have to move their offer down to meet the buyer's bid. So it's like a literal tug of war.
Oh, that's the perfect analogy.
Right, because you have these two opposing forces pulling on a rope, and if nobody steps forward...
The rope just stays tense.
Exactly. The rope just stays tense, nothing happens, no trade occurs, and that price on your screen, it doesn't move at all.
Not even a tick.
So for the transaction to take place, someone physically has to yield. A buyer steps up or a seller steps down.
And that yielding is the engine of the entire system.
Wow.
I mean, the constant tension of that tug of war is precisely what generates the price action you see moving across your chart every single day.
So, okay, if there is this constant tug of war where someone eventually has to yield, you kind of have to be able to see who is pulling on the rope, right?
Right, you need to see the battlefield.
Yes, you need to know where the battle is actually taking place. And that leads us directly to the battlefield itself, which is the order book.
The order, I mean, this is one of the most vital concepts for you to internalize as a beginner.
For sure.
It is a real-time, constantly updating ledger of all the pending buy and sell orders currently sitting in the market.
So it's basically a list of everyone waiting to do something.
Exactly. It shows you the depth of the market at various price levels.
Mm-hmm.
When you look at an order book, you're not looking at the past. You are seeing the actual physical supply and demand just waiting to be triggered.
Okay, let's help the listener visualize that ledger. Let's say you have two columns.
Okay.
On one side, you have the buyers, and they represent demand. They are actively seeking to accumulate a position.
Right.
And their resting orders essentially create a floor for prices. Because if demand outweighs supply, these buyers start competing with one another.
They have to.
Right. They offer higher and higher prices to ensure they actually get filled, which physically drives the market upward.
And then on the flip side of that ledger, you have the sellers, right?
Mm-hmm.
They represent supply.
The ceiling?
Exactly. They are the side seeking to distribute or, exit a position. So their resting orders provide a ceiling.
Makes sense.
And when supply outweighs demand, those sellers start to panic a little bit. They have to compete with each other by lowering their asking prices to attract the few remaining buyers.
And that competition drives the market downward.
You got it.
Wait, okay, I want to pause here. Because I'm confused about something that I think trips up a lot of beginners. And it tripped me up for a long time.
Sure, what is it?
We hear this phrase all the time. For every buyer, there is a seller.
Oh yeah, the classic phrase.
Right. But if that is true, and the market is just buyers and sellers matching up perfectly one-to-one, shouldn't the market just be completely balanced?
That is the logical assumption, yeah.
Like, why would the price ever move? Shouldn't the chart just stay completely flat forever if everyone is perfectly matched?
That is the million-dollar question right there. And it comes down to a really fundamental misunderstanding of urgency.
Urgency.
Urgency. You have to separate market participants into two very distinct categories, passive and aggressive.
Okay, passive and aggressive.
Right. So the orders sitting in the order book, the ones we just talked about, waiting for a specific price, those are passive.
They're just chilling there.
Yeah, they're limit orders. They are providing the liquidity to the market. But price only moves when an aggressive participant enters the arena.
Ah.
This is someone using a market order, which basically says, I don't care about negotiating. I want this asset right this exact second at whatever the best available price is.
Oh. So they are the ones forced to cross the spread and yield.
Precisely. They're the ones crossing the spread. So let's say a massive aggressive buy order enters the market.
Okay.
It's so big that it completely exhausts or, eats up all the passive sell orders sitting at the current asking price.
Give us an example of how that looks mechanically.
Sure. Let's say you want to buy 1,000 shares right now, but there are only 200 shares being offered at the current price, which is, let's say, $10.
Okay, so I want 1,000, but only 200 are available at $10.
Right. So the system gives you those 200 shares.
But I still need 800 more.
Exactly. And for your order to finish filling, the price must physically move higher. It has to search the order book to find the next available seller, who might be sitting at $10.05.
So it just automatically bumps me up to that higher price.
It does. It consumes those orders and it keeps moving up the ladder, price level by price level, until your aggressive order is completely satisfied.
Wow. It is basically a vacuum. The aggressive order just sucks up the liquidity and the price just moves up through the empty space to fill the vacuum until it hits a new, thicker wall of sellers.
Yes, which is exactly why we need to address a massive misconception here.
Let's hear it.
People often think price moves because of some magic chart pattern, or because two moving averages finally crossed on a screen, or because an indicator flashed over bought.
Right. Everyone loves their indicators.
They do, but that is entirely backwards. Price does not move because of a mathematical indicator. Price moves simply and exclusively because the supply at a specific price level was entirely consumed by aggressive market participants.
Wow, so it's not magic.
It's not magic at all. The market is forced to seek the next level of liquidity to fulfill the remaining orders. It is cold, hard math.
Okay, but this concept of consuming supply naturally raises a pretty terrifying question for you, the listener.
Terrifying.
Well, yeah. What happens if there just aren't many passive orders sitting there to be consumed?
Ah, right.
What if that order book is mostly empty and someone comes in with a huge, aggressive order?
Well, that introduces what might be the single most critical concept in all of trading: liquidity.
Liquidity. Let's dig into that.
Liquidity is the lifeblood of any functional market. By definition, liquidity is the ease with which you can enter or exit a position without significantly affecting the asset's price.
So a highly liquid market has a massive volume of trading activity.
Right, and a huge, dense stack of passive orders sitting on both sides of the order book.
Meaning you can buy or sell large quantities almost instantly without the price budging because there is always a counterparty ready to absorb your trade. The text we are using today describes this as the thickness of the market. And I love this visual.
Ocean visual.
Yeah, think of a thick, highly liquid market like the S&P 500 futures, or a major currency pair like the euro against the US dollar as a massive ocean.
Okay.
If you throw a 100-share order into a highly liquid stock, it is literally just a tiny drop in a massive ocean. The market completely absorbs your transaction and the overall water level doesn't change at all.
Right, but now take that exact same drop, that exact same 100-share order, and throw it into a thin, illiquid market, like a low-volume microcap stock.
Oh boy.
That drop is no longer hitting an ocean. It's hitting a small puddle.
It creates a violent splash.
A huge splash.
Yeah.
Because there just aren't enough resting orders to absorb your transaction. So your single, relatively small order might eat through 3 or 4 different price levels just to get filled.
You end up causing a massive price swing all by yourself.
You do. And it is crucial to understand that liquidity is not a permanent attribute of any market. It shifts constantly.
Right, it's not static.
No, it changes based on the time of day, impending economic news, general sentiment. For example, global markets are traditionally most liquid during the overlap of major trading sessions.
So specifically the few hours when both New York and London are open simultaneously.
Exactly.
Yeah.
Because you have the absolute maximum number of participants awake.
They're at the desks, they're drinking their coffee, they're placing orders.
Yeah, and that high concentration of participants leads to much tighter spreads and far more predictable, structured price movement.
But on the other hand, when liquidity dries up,
That's when it gets scary.
yeah, say during a national holiday, or in the incredibly tense minutes right before a major government jobs report is released, the market becomes incredibly fragile.
Super fragile. It becomes prone to erratic, dangerous behavior because the order book basically just thins out.
Which perfectly illustrates why the thickness of the market dictates your safety. It brings us to this fascinating inverse relationship, the relationship between liquidity and volatility.
Beginners always get this wrong.
They do. They often think they want maximum volatility to make money. But if you want stability and safety, you actually need massive liquidity.
Because high liquidity leads to price stability.
Right.
It takes a staggering amount of aggressive capital to chew through all those thousands of orders and actually move the price.
It creates this smoothing effect on the charts.
Right.
Yeah.
In a highly liquid environment, the price tends to move in a linear, structured fashion. It eats through the layers of the order book systematically, tick by tick.
And for a retail trader, this stability is your best friend.
Oh, without a doubt. It dramatically reduces the risk of being caught in a flash move where the price just completely disappears from underneath you.
But let's talk about the danger zone. Low liquidity, the puddle.
The puddle is dangerous.
Because low liquidity is the primary driver of slippage and what traders call gapping.
Let's explain gapping because it's terrifying if you don't know what it is.
Okay, let's say you're in a trade, it starts going against you, and you attempt to sell the asset to protect yourself from a bigger loss. So you click sell.
But you're in a low liquidity environment.
Right. When your aggressive sell order hits the market, nobody is there.
Just empty space in the order book.
Literally an empty space. So the system desperately looks down the order book for the next available buyer. And that buyer might be sitting 1 or 2% completely lower than the current price.
And that is the mechanical reality of a gap. There is a literal hole in the order book, and the price has to drop violently, skipping over multiple price levels entirely, just to find the next participant willing to catch the falling knife.
It just bypasses all those intermediate numbers.
It skips them. This is exactly why you see those long wicks on candlesticks or huge vertical bars that just blast through support levels. The order book was hollow.
So you don't even get a fair chance to exit at those intermediate prices. Like, you wanted out at $50, but the system couldn't find a buyer until $48. You just suffer the loss.
You eat the slippage.
Yeah.
And this is a point that is highly counterintuitive for beginners.
How's that?
Well, people see a crazy, volatile, fast-moving chart, and they assume, wow, there must be a frenzy of trading activity going on there.
Everyone must be buying and selling.
Right, but often it is the exact opposite. High volatility is frequently caused by an absolute lack of participants.
Wow.
There is no one there to absorb the trades, so every single isolated order throws the price around violently.
That makes so much sense.
That is why professional traders avoid the illiquid hours of the late afternoon or the early Asian session. The lack of participants makes the environment totally unreliable and genuinely expensive to trade because of that slippage.
That is such a vital distinction to make for the listener, because if a violent gap happens because there is literally no one there to take your trade, it underscores the most humbling foundational reality of the market.
And what's that?
Every single time you click buy, there must be a real person or a real entity clicking sell on the other side.
Yes.
You are never trading against a video game. Which brings us to the search for the counterparty.
Clearing this psychological hurdle changes everything for a new participant. When you enter a trade, you are not buying from the market in some abstract, cloudy sense.
Right.
You are buying from a counterparty. That could be another retail trader sitting in their living room in London. It could be a major bank in New York, or it could be an institutional market maker.
Yeah.
But a specific entity is taking the other side of your bet.
It is a fiercely competitive environment. I mean, let's say you are buying because you are absolutely convinced, based on your analysis, that the price is going up,
Okay.
while your counterparty is selling to you because they are equally convinced the price is going down.
Exactly. Or perhaps they're an institution being paid a premium to provide that liquidity. But either way, in the short term, this is a zero-sum environment.
For you to profit, you must be on the right side of the liquidity flow, and someone else eventually must be on the wrong side to provide the exit you need when it's time to take your profits.
And understanding that zero-sum dynamic completely changes how you view the big players in the market.
The whales.
The whales. Because large institutional players cannot enter the market the way you or I can. If a retail trader wants to buy 10 shares, they just click a button, done. The ocean absorbs the drop.
No problem.
But if a massive hedge fund wants to acquire $500 million worth of a stock, they have a massive mechanical problem.
Oh, because if they just click buy all at once with a market order,
Which would be insane.
they will instantly consume all the available supply in the order book. They would chew through every level of sellers and drive the price up 5 or 10% against themselves.
It would ruin their own entry price.
Yeah.
They'd be causing their own slippage on a massive scale.
So they can't just do that.
No. So they have to actively hunt for pockets of massive selling interest. They need to find a place where a ton of people are panicking and selling so the whale can step in and quietly absorb all those aggressive sell orders with their massive passive buy orders.
That makes me think of a real-world scenario to put this in perspective. Imagine you are trying to quietly buy 1 million apples in a tiny farming town.
Okay, 1 million apples.
If you just walk into the town square with a megaphone and shout, "I want 1 million apples right now," everyone would immediately realize there is a massive surge in demand.
Right, the secret's out.
The farmers would instantly hike their prices, and the cost of apples would skyrocket before you even bought your 10th basket.
Exactly. So if you are the institution in that scenario, you have to sneak around.
It's gonna be stealthy.
You buy a few baskets here, a few baskets there. You use hidden orders or iceberg orders that only show a tiny fraction of your true size to the rest of the market.
Oh, wow.
You specifically wait for a day when a bunch of farmers happen to be panicking and trying to sell off a surplus, and you quietly absorb their panic.
And that search for liquidity, that desperate need for institutions to quietly fill massive orders without tipping their hand, that is what actually drives the complex patterns you see forming on a price chart.
It isn't magic geometry. It is the literal footprint of large capital trying to maneuver within the constraints of the order book.
It's all connected. So we have these big players and we have regular retail traders all interacting mechanically, but the way they behave isn't purely robotic, right?
Not at all.
It is heavily influenced by the broader mood of the world. And that brings us to the intersection of cold execution and human emotion. Market sentiment.
Because markets do not exist in a vacuum. The willingness of those buyers and sellers to interact is completely saturated by the external environment, the news cycle, and economic reports.
So when the economic outlook is positive, you have a classic bull market.
Right. And buyers become highly aggressive. They're willing to pay the ask. They cross the spread without hesitation.
Meanwhile, the sellers become hesitant, constantly pulling their offers higher and higher because they know buyers are desperate.
Exactly. But when the outlook turns grim, the exact opposite happens. You get a bear market.
Panic.
Total panic. Sellers become the aggressive participants, hitting the bid at any price just to get out of their positions. Meanwhile, the buyers, the people supposed to be providing the floor, they just completely vanish from the order book.
They cancel their limit orders and step back to watch the carnage.
They do.
But here is the most fascinating part of the text we're analyzing today. Despite all that emotion, despite the panic of a crash or the euphoria of a massive rally, the actual mechanics never change.
Never. The mechanical execution is always exactly the same. The price just moves to the next available level of liquidity.
Always.
Let's say a piece of global economic news drops, and it is so shockingly bad that every single buyer instantly pulls their buy orders out of the order book. They just delete them. What happens mechanically?
The market goes into a free fall.
But it's not falling because of some magical gravitational pull. It is mechanically dropping, searching down through the empty price levels in the order book.
We're looking for a floor.
Looking for a floor. It drops and drops until it finally hits a level low enough where a group of buyers finally says, okay, the panic has gone too far. This asset is now such a ridiculous bargain that I am willing to step back in, risk my capital, and provide a floor.
That terrifying free fall is literally just the market's mechanism for finding a new equilibrium in response to new information.
That's all it is.
So what does this all mean for you, the listener? Why do we care so deeply about the granular mechanics of the bid, the ask, and the order book?
We care because when you truly internalize these cold mechanics, you can finally stop trying to predict the future.
Yes.
You stop looking for secret predictive magic in the charts, and instead you start observing reality.
You start looking for where other participants are trapped in bad positions?
Exactly. You look for where they are being highly aggressive, and just as importantly, you look for where they are completely absent.
So you shift from being a fortune teller trying to guess the next move to being an interpreter of the current auction.
It's a profound shift in perspective. To wrap this up, if you are going to navigate the financial environment effectively, you have to respect the eternal relationship between volume, liquidity, and price.
Because high volume and high liquidity mean you are in a safe market. You have tight spreads, low transaction costs, and a transparent, reliable ability to get in and out of your trades.
But low volume means you're stepping into a dangerous market. It doesn't matter how great the potential profit looks on a setup. If there are no participants, your exit is completely unpredictable.
You could get trapped or gap down and suffer massive slippage that wipes out your entire account.
And we don't want that. Every single candlestick on your screen, every trend line you draw, every fancy indicator that people sell online, they are all just derivatives of this one core interaction.
Buyers and sellers meeting in a digital arena facilitated by liquidity, fighting a continuous tug of war to determine value in real time.
Without that constant flow of liquidity, without that friction between human beings deciding what something is worth, the entire system simply ceases to function. Your ultimate goal as a participant is to learn how to identify where that liquidity lives.
You have to learn how to move alongside the largest flows of capital rather than standing in front of them and getting run over.
Very true.
Well, I want to leave you with one final provocative thought to mull over today. We spent this whole time talking about this grand global electronic network, but think about how these exact same mechanics apply to your everyday life.
Oh, this is a great point.
Have you ever noticed how the perceived value of an item changes instantly when you realize you're competing with 3 other buyers at an estate sale or a local auction?
Suddenly you really want it.
Right. You might not even want that antique lamp that badly, but the moment you see someone else reach for it, your internal bid skyrockets.
The urgency hits you.
You suddenly feel the urgency to cross the spread and just pay the asking price. The financial market is simply that exact human urgency, that exact same fear of missing out and need for value, scaled up to millions of decisions per second. It's human nature, quantified.
It really is.
Thank you so much for joining us for this deep dive. Remember to visit www.franksreport.com for more insights, and we highly recommend you check out the book, The Funded Micro: Modern Future Strategies for the Prop Firm Era.
Highly recommend it. It takes everything we just discussed about liquidity and order flow and applies it directly to modern trading strategies.
Absolutely. Until next time, keep your eyes on the liquidity.
Cold water in a glass. No noise left to decipher. Settle the